Hello everyone, welcome back to Core Investing. In this video, I'm going to show you how I made over $3,000 trading put credit spread, one of the options trading strategies. Let's get started. Let's quickly go over the topics of today. I will first talk about what is a put credit spread, then why we use this trading strategy, how we create a put credit spread, and I will show you some examples to make sure you will have a solid understanding of trading put credit spread. This channel is all about investing in public companies as well as private companies. If you are interested in these topics, make sure you subscribe to the channel. I'd appreciate your support. I'm assuming that you already know the basics of option terms. For example, strike price, expiration date. If you don't know these terms, I highly recommend you pause this video and look at my previous videos. I talked about the option trading basics and the put option trading 101. So you can find the videos here and here. So what is a put credit spread? A put credit spread is one of the options trading strategies. It is used when you think the stock price is going to stay the same or increase. You are neutral or bullish on the stock price. So put credit spread is often called bull put spread as well. Why do we use this trading strategy? Reason number one, income generation. So one of the biggest reasons investors trade put credit spread is to generate extra income. I personally traded put credit spreads just a couple months ago, and I've already generated over $3,000. Reason number two, leverage. You use less money to gain exposure to the stock price. For example, Amazon is currently traded at around $3,000 per share. Say you really like the stock, but you don't want to spend $3,000 just to buy one share of Amazon. So what you can do is you can trade a put credit spread to gain exposure to the stock price with less commitment. Reason number three, this strategy has defined risk and reward. You have a maximum profit and a maximum loss that you know before entering this trade. All right, let's move on to how can we put together a put credit spread. So essentially, you open two put option positions with different strike price, and on the same stock, you sell a more expensive put option and buy a cheaper put option. You make money on the spread. Let me show you an example. Well, I'll talk about this in details. All right, let's look at the Amazon stock. It is currently traded at $3,030 per share. Let me quickly show you my past put credit spread trade so you get a sense of how does it work. So these are some of the put credit spread I've traded. These are the net profit I've received. Just quickly show you an example. Essentially, you open two put option positions on the same stock with different strike price, and both expire on the same day. Here, you just click trade Amazon options, and instead of calls, so you click put. So this is the current share price. And so you can see this is the strike price, your break-even price is the stock price, and then to break even, this is the number of percent the stock price needs to move. This percentage change basically means the percentage change of this contract value. And then this is how much money this contract is being traded. So what we're gonna do is that we buy a cheap put option, and then we sell a more expensive put option. So one thing I want to note, for put options, the higher the strike price is, the more expensive the contract is. So the reason is that put option gives the buyer the right to sell at the strike price. So if the strike price is higher, the put option buyer can sell at a higher price. So this is why you can see as the strike price increases, the value of the option contract increases as well. And this is only for put options. All right, coming back to our put credit spread. So here I am buying a put option at $3,030 strike price, expire on February 25th. And in the meantime, I'm selling a put option at $3,035 strike price and expire on the same day. The net profit I will receive on these two option contracts is $2.63 per share. Remember, one option contract is equivalent to 100 shares. So the total credit I will receive is $263, which is also the maximum profit I will gain by trading this contract. Here is a little chart to show us expected profit and the loss. So the green area is our expected profit. The red area is the expected loss. As you can see, both are limited. As long as Amazon stock price stays the same or above $3,030, our profit is $263. So because put option gives the buyer the right to sell at the strike price, if Amazon share price is above the strike price, the buyer will not exercise the contract because the buyer can sell in the market for a higher price. If the stock price decreases, say decrease to $3,000 on the expiration date, then the option that you bought will be exercised. So you will exercise the option because you can sell your option at $330, right? You will exercise your first put option. And then your second put option that you sold will be assigned because the buyer of this contract can exercise, right? Can sell you at $3,035, and then you are obligated to buy it at this price. So in that case, your loss is $500. But because initially you received $260 profit, so by creating this spread, your total loss is $237. So let me show you another simple example to make sure you have a solid understanding. Stock XYZ is currently traded at $100. You are optimistic about the stock's future. You think the stock price is going to at least stay the same or increase. You decided to open a put credit spread. You sell one XYZ put option at a higher strike price. So we are assuming $90 the strike price for $3. And then you are buying a XYZ put option at $80 strike price for $1, and both expire on the same day. Your net profit is $2 per share. So because each option contract represents 100 shares, your net credit is $200. And that is your maximum gain. So if stock XYZ is traded above your higher strike price, so in this case $90, so if XYZ is traded anywhere above $90, so we are assuming 105 per share at expiration, both of your put options will expire because both put options have a lower strike price. Your gain is the net credit you received. If the stock price falls to say $50 per share, you will exercise your put option that you bought at the strike price of $80. So you will sell 100 shares of XYZ at $80, even though the market price is $50. Selling 100 shares or exercising this right, you will receive $8,000 just by exercising this right. Since you also sold a put option at a $90 strike price, the buyer of that option will exercise the right to sell you at $90 per share. So in this case, this is called you will be assigned. So you will need to buy 100 shares at $90 per share. So you pay $9,000. your net loss is the total you received minus the total you paid. So you received 8,000 by exercising your long put option, and you also received the $200. That's your net credit. And you paid $9,000 because your short put option got assigned. So your net loss in this case is $800. You can also use a very simple formula to calculate a total loss, which is using the higher strike price minus the lower strike price minus the net credit that you received. But I wanted to go over this example so you can logically understand what is happening. So what happens if the stock price is in between your two strike price? So for example, if XYZ is $85 on the expiration date, what will happen? So essentially, you will not exercise your 80 strike price put option because you can sell it in the market for $85, right? So you will not exercise the right. So you will just let your put option expire. For the option that you sold at $90 strike price, so this option will be assigned because it's in the money, because the buyer of this contract will exercise the right to sell you at $90 per share. So in this case, you will pay $9,000 to buy the stocks. You can then sell it in the market, right? Because the current market price is $85. You can sell in the market for $85 per share, and your loss will be $500. But since you also received the $200 net credit, your total loss is $300 in this case. Long A option means buy option. Short means sell. So remember, long is buy, short is sell. Just quickly summarize. If the stock price is above both of your strike prices, both options will be expired. Then you will keep your net credit. So this is typically done automatically by the brokerage, so you don't need to do anything. If the stock price is in between your two option strike price, your long put option will expire. Your short put option will be assigned. So depending on the stock price, you may experience a gain or loss. If the stock price is below both of your options' strike price, your long option will be exercised. Your short option will be assigned. So this is your maximum loss scenario. If you liked the video, make sure you subscribe to the channel. I will post more videos about option trading strategies. Don't miss that. Thank you. Bye.